American Express, Valerie, what do you know about American Express? What stands out to you about that company?
They like to boast about having no limit on credit cards. That's kind of the big thing that I've heard.
Yes. Well, this patriotic, altruistic, selfless company rolled out the first private pension plan in 1875. And while some might look at that and say, okay, well, yeah, life expectancy was like 39 at that time, so people didn't even have time to really even have like a midlife crisis, I would argue that this storied company has made an even bigger sacrifice by substituting these pensions for points. 4-star hotels, 4-star restaurants for retirement. I don't think there's any other way that you can adjust for inflation better than that.
So for its employees, instead of getting a pension, they get points?
Yes. And today, if by chance you don't have points, and maybe, again, we're just fixating on pensions today we're going to talk about if you're lucky enough to actually have a pension still. Mm-hmm. If you have a pension through a government, if you have the pension maybe through some private company that you work for that isn't American Express. And if you do have a pension, you're probably wondering, okay, well, what do I do with this thing when it comes time to retire? My name's Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Valerie, how are we doing?
Doing great. Back from a long Labor Day weekend, so ready to chat pensions.
Yeah. I mean, again, pensions, I think most people are kind of aware the basics of what it is. You work for a company and they set up some future income stream for you at some point in time. Okay. Used to be a lot more prominent. When people think pension now, they probably think those don't really exist as much anymore, which is accurate. But if you're fortunate to have a pension, you probably have a few different options. You probably have a lump sum option. You probably have a single life option, a joint option, and then variations of those three, right? So there's typically those three primary options and then several different variations of them. But before we jump into really what might make sense for somebody, what are some of the factors that someone should consider, Valerie?
Yeah. So I think one of the biggest things are for you personally, what does your health look like? If you're having a big health issue that, maybe it's going to shorten your life expectancy, that could be something that you're thinking, taking payments a little bit at a time, maybe won't work out best for me. Age, right? If you're retiring pretty young, and your pension still allows for a full payout, then that could be something that you definitely want to think about. And even longevity within your family, do you have parents, grandparents that lived, till their late 90s, hundreds? Or is it that everyone's pretty much around 70 and that's the end for them? Certainly some of the bigger factors to look into that just personally, as far as your own well-being. And then that doesn't even go to mention what your financial plan looks like. What kind of assets do you have aside from that pension as well? And do you have a plan if you have a big emergency? How are you going to go about paying for that? So those are just sort of the biggest off the top of my head factors
that should, I might add to that, risk tolerance, like how comfortable you are with, let's just say, taking some ownership, which you'll get into with the lump sum option. But also, I think there are factors or considerations from a company standpoint. So like solvency, potential risk of, the company moving forward, the financial stability of the company moving forward. And, people might counter that with, I've heard about, pensions going bankrupt, but there's this pension benefit guarantee corporation that guarantees my pension. Unfortunately, kind of similar to Social Security, they're running out of money. In fact, in their latest publication, 2021, they said, hey, we don't have enough money to keep guaranteeing these pensions. So what the PBGC actually does is these companies pay a premium to get insurance in case they can't pay out pension let's just say participants.
Mm-hmm.
Well, more and more people are needing to take some type of insurance claim off of that because their company is unable to pay out the pension, such as Lehman Brothers, Circuit City, United Airlines being a few examples. So you might want to also check and see, okay, what's the financial stability, and factor this into your decision in case, the pension benefit guarantee company can't cover, in the event of your company going bankrupt, your pension, or at least can't cover the full amount. So something also to consider there, right?
Right. Yep. Yep. And a lot of times companies will restructure. They won't just go and it go directly to the pension board. They'll restructure it first and say, actually, we're splitting it in half and we're only paying half of the benefits. And so we're fine. Everything's totally great. Not for the retirees, but for the company.
Right.
So again, there's lots of loopholes that sometimes leave retirees sort of in the lurch.
Yeah. Similar restructure of like points for pensions with
Yes.
good old American Express. But we're not picking on them today, although again, they're the first company that did roll out the pension. So why don't you maybe just explain a little bit more what the lump sum option is? This big number that maybe you see when you log in, you see, hey, my pension's worth this much. Here's the lump sum option that I would have available if I were to choose that.
Yep. So that one really is the most straightforward. What you would do is that big number that you see, you get that all at once. And if you want to keep it qualified, meaning that you're not going to have it become taxable all at once, what you would want to do is roll it over. You would roll that over into an IRA. And so really the step is to open an IRA at a different company, wherever your finances are. Usually if you have a financial planner, wherever they custody the money, there's an IRA open. You would do a rollover and just move it over into that IRA. Now you are in control of your destiny as far as using that money. If you left it with a pension, they're the ones that are taking the risks, quote unquote, making sure that money lasts forever. But now it's yours. You have to pick the investment options. You have to decide, am I going to buy or sell now? Am I going to just be a disciplined investor and leave it for the long term? And it also just allows you to really say, okay, I'm going to remodel my house now, and I'm going to need a whole $100,000 all at once. If you were to do the pension payout, that wouldn't be an option. And so this really is going to be something that's for a little bit higher risk tolerance, because again, you're not relying on somebody else to decide or to make sure that your money lasts for the rest of your life. And you have to be able to make some decisions on your own or with an advisor.
Right. There's the responsibility that comes with it.
Mm-hmm.
And yeah, it might make sense, kind of depending on a number of different variables there, as you outlined. Again, another one to probably consider is, do I feel confident in my company's ability to continue to pay out this pension, even if there is some type of insurance coverage there through the PBGC? Probably don't want to be leaning on that, given that the PBGC came out and said we're going to run out of money in 2026. So I would say there's some factors certainly to consider there as to, okay, maybe I should consider getting the lump sum option and taking on a little bit more responsibility, but having a little bit more certainty maybe in other ways. Trade-offs as always. There's trade-offs as always. Now for the other two options, the two other primary options, you have the single life, which is just on one person. You get the highest monthly payout through this option. So if you choose the single life payout, and again, really what pensions are, it's an annuity. I know annuity is getting tossed around in all different ways today, so people have different thoughts about annuities. Annuity just means pension, right? So if you have the single life annuity option, that is typically the highest monthly payout. Now, if you pass away, then there is no monthly payment that would be going on to the next beneficiary. And this is a lot of times there's the lump sum option, but this is listed as the first option for many folks when they look at their pension options. Option one is single life annuity. Now, things you want to look into here: does it adjust for inflation? What are the adjustments that are being made for this? And of course, there's variance below this. There might be some small death benefit or some small continuation of the benefit, but typically those variations are on the joint life option. So option number 3 in this case, so we have lump sum, single life option, and joint life. And joint life is if the pension participant passes away, there's a benefit then that then goes on to likely the spouse, could be some other beneficiary, depending on how it's set up and who you choose. But that would be obviously a reduced benefit in that case, right? So the single life option, hypothetically, maybe you get $3,000. The joint life option a month. The joint life option, maybe you get $2,500 a month or $2,700 a month. It's reduced, but if you pass away, that benefit continues on for your spouse, or 50% of it continues on for your spouse. And those are the two primary variants that you would see outside of just lump sum, right? So single life and joint life. But how do you know which you should choose, and really what you should consider? I think that's a question a lot of people have, Valerie.
Right. And one thing I would throw in there, there's so many unknowns, right? That's always a thing with financial planning. Who the heck knows exactly when I'm going to die? But what we could do is, I think I help clients to make that decision just by turning to math and saying, okay, we're just going to look at something that is very, set in stone, and we can pick which formula comes out better. And so one place to start is just to say, okay, standard life expectancies, right? So if the standard life expectancy for a joint or for a single life is 85, and the pension is going to pay out X dollars, what's that rate of return that the company is effectively paying me to do that? And now let's just say it's 2%, just to keep it even. Let's say it's 2%. And then you say, you know what, I think I can invest and I have the tolerance to make better than 2% rate of return on my investments. And so that could be one of the formulas to try and, help you decide, well, which one's going to be the best one.
Yeah. And I think it comes back to also the, considerations we outlined at the beginning. So like, if you are unhealthy, let's just say you're severely unhealthy, you maybe look at longevity of life and you're like, I just have some disease or some history of just my family not living very long. Lump sum is probably worth considering more in that circumstance. And that's probably fairly intuitive for most folks. But if you have a decent longevity within your family, you probably might consider looking at the annuity options a little bit more. If you're married and your spouse is older than you, well, now it's kind of like, okay, if I choose the joint life option, my spouse maybe is likely to pass away before I am. Is that really the best option? Well, if your spouse is maybe younger than you, it becomes maybe a little bit more understandable to choose the joint life option. So I would say age, longevity really impact that as well. There's one other strategy, if it's okay with you. I don't know if you want to add on to that. There's one other strategy that I think is worth going through, because this gets talked about a fair amount. But is there anything else you wanted to just touch on there?
No, I don't think so. Definitely, if there's a wide range of age, and let's just say, I guess something else maybe to add, that the spouse, the one who doesn't have the pension, let's just say that spouse is a spendthrift, somebody that doesn't have a really good management of money, and won't be able to take on responsibility of that big lump sum. Then that could be something else, that somebody just says, I feel more comfortable with knowing that he or she will have a set paycheck every month, and that's going to be the better planning scenario for them.
Yeah. Yeah. I mean, obviously, just having some personal awareness there is really important. So one strategy gets tossed around a lot is pension maximization. And I think this gets talked about a lot because it involves an insurance product and insurance companies. And so you're likely, if you sit down with any insurance company, to at least broach this conversation in some way. And I think we have a tendency to hear insurance and get pretty cold and not be open to the idea of it. I will say that this strategy is probably worth considering if there are a couple different variables in place. So first, I'm going to cover just what it is. A pension maximization strategy, if you hear that terminology, it's typically when you have the pension participant take the single life highest payout option. You then take a portion of that monthly income and place it into a life insurance policy. So you make a life insurance monthly payment off of a portion of that monthly pension payment. Okay. So maybe it's, the single life option again is $3,000 and the joint life option is $2,500. So you say, okay, hey, I'll take the $500 a month difference and I'll put that on a life insurance policy on myself. And if I pass away, there's a death benefit that then goes on to my spouse or beneficiary. Now, some pieces to this, again, the idea is once you pass away, that death benefit would go to your spouse. So it would replace that otherwise joint income need that you would have in the third option, the joint life option. If you're unhealthy, this probably isn't an option, or it's just going to be too expensive because you have to go get typically underwritten for an insurance policy. So again, depends on health. If your spouse is significantly younger than you are, and this depends on how the pension's set up, but maybe they don't discriminate on age for the survivor benefit. They typically do. But if the survivor is significantly younger than you are, it's going to probably be hard to replace the entire income need through that death benefit, because theoretically there would be a larger need because that person would be living longer. But if that spouse is near the same age or older, okay, well, maybe this is something that you consider a little bit more, because you're looking at it and you're saying, I'm probably going to outlive this beneficiary, but I could get a death benefit in place to cover them, or at least a term policy and maybe a permanent policy, because the risk here is if you do this and you pass away early on, because, again, that would mean that you'd have a larger income need for your survivor.
Yeah.
One way to maybe cover that is a term policy with it, but.
Right. Yeah. And I mean, when you were saying the insurance perception, I definitely am insurance cautious myself. Just because the products can be very complicated and they can be very expensive with a lot of internal things going on that maybe you don't necessarily know about. And so I think a big part of that equation is just figuring out, what kind of coverage can I afford? And is that going to be something that it's going to even be feasible with, after all, everything is said and done. So certainly worth the conversation, but I think it's, like you said, it's not a magic bullet. And there's just a lot of different things can come into it.
Yeah. Again, it's really just dependent on, a number of different factors. I bring this up because you might get into the room with somebody that is soliciting this product and think it's like the greatest solution in the world. It can be a good solution, but again, there's other factors to consider. I would just tread carefully a little bit here, but also be open to the possibility that an insurance policy might actually be something that makes your financial plan better. There is that possibility. It's not like these things are just all bad, right? I would be open to it, but again, tread carefully as you go through that conversation. So
perfect.
Hopefully that was helpful. Again, we covered the different pension options, the different potential solutions and considerations. Again, this is Your Life Simplified, brought to you by Mariner Wealth Advisors. I'm Michael MacKelvie. I was joined today with Valerie Escobar. You guys take care.
Thank you.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.